of tea about what's going on inside Washington, D.C., what regulators and lawmakers are thinking and working on, and how you and your credit union should be evaluating risk areas and areas of opportunity. My name is Ann Petros, your host, and I'm NAFCU's Vice President of Regulatory Affairs. And today I'm joined by a special guest, Dan Coates, Deputy Director of the Division of Research and Statistics at the Federal Housing Finance Agency, or FHFA, which also regulates Freddie Mac, Fannie Mae, and the Federal Home Loan Banks. And today we'll be talking about climate change risk and addressing some of the questions that you may have about how climate change may impact your institution. So, Dan, thank you so much for joining me today. We really appreciate having you.
Thanks for having me.
Yeah, definitely. All right. Well, let's jump right in. And first, can you explain what, role financial regulators can play in evaluating climate change and the risks that it poses to the housing market, and, how the FHFA has been involved with other regulators, including through the Financial Stability Oversight Council, or FSOC?
Sure. So financial regulators can play, I think, a very important role by ensuring that our regulated entities manage their risks. And climate change is yet another risk that institutions have to manage. It's unlike some other risks because it's something we know probably a lot less about. So there's a really important role for regulators to ensure that the regulated entities are doing what they need to do to manage climate risk. In terms of our involvement, we've been involved for quite some time, actually, when then Deputy Director Thompson, now Director of the agency, when she came in 2013, she set up a rapid response team that we formalized in 2019 to actually help ensure that remediation, loan modifications, forbearance options were all available to not only homeowners but renters in the wake of a natural disaster. So that's been an ongoing effort with FHFA and our regulated entities. As time went by, though, we realized there's a lot more we have to learn about this. We put out a request for input last year, and we had a listening session. A lot of really smart folks came and offered their views. I appreciate NAFCU's comments and those of the Credit Union National Administration. Those were really thoughtful comments, so thank you for those. And that listening session, by the way, is available on our website. You can go there and watch it. And we also have a summary of the comments. So what have we been doing since? Well, we've been trying to understand all the and act on the comments that we got. So we've been continuing to meet with various stakeholders, and we're moving forward. Then Acting Director Thompson issued a statement at the end of last year saying that climate change was a priority for our regulated entities and for FHFA. I think that was a very important step in moving forward in recognizing that climate change and its consequences pose risks to our financial institutions and to everyone, really. So this was a really important statement that she made. In early part of this year, we set up a number of working groups and a steering committee structure to ensure that climate change and ESG more generally were adequately prioritized across our agency and at our regulated entities. So the steering committee is our heads of divisions and offices, and they provide the leadership to our 8 different working groups. And I can go on about the working groups if you like. But that's, we've been pretty busy, and we're really trying to learn as much as we can and and move forward in this area.
Yeah, that's great. And it sounds like there may be staff dedicated to evaluating just this issue, within FHFA. Is that accurate?
Yeah, we have a climate risk branch in DRS in my division, but we also have dedicated staff from across the agency. This working group design, the steering committee design was deliberate because we understand that everybody in FHFA is going to have to be involved in learning about climate change and its consequences and trying to come up with meaningful and reasonable adaptations and potential solutions. So it's really a whole of agency approach because the director has said this is a priority for the agency. So
that seems appropriate, not something you can really do in a silo.
Right.
So, how is the FHFA and by extension, the regulated entities, Fannie, Freddie, and the Federal Home Loan Banks, how are they, thinking about climate change risk, more specifically?
Yeah. So, we are predominantly, we have a couple of things we have to do, right? We are a safety and soundness regulator, and we are a emission regulator. So we're trying to make sure that our regulated entities remain safe and sound, but also that they provide all of the incentives for sustainable home ownership. Our director, Sandra Thompson, has been really pretty adamant that she wants to ensure that any opportunities we open up for people who were previously unable to access housing, that those opportunities be provided in a way that maintain the safety and soundness of not only Fannie and Freddie, but also the Federal Home Loan Bank. So that's been a pretty strong desire of hers, based, I think, on her background. She was at the FDIC during the last financial crisis, and she saw the consequences of people being evicted from their homes and the tragedies that was, right? And so I think of climate in the same way. When we think of sustainable home ownership, we think of not only can you stay in that home if the economy fluctuates and interest rates move around, but also can you stay in that home physically, right? Is the roof going to be blown off by some really bad storm? What happens to the costs of maintaining that home if there are what we call transition events? So insurers unwilling to or charging higher rates for a given location. So we want to make sure that when we talk about sustainable home ownership, we're talking about it not only in the in ability to keep making your payments, but also ability to stay in the home despite the consequences of climate change. So that's one of the ways, that's kind of the view from which we look at this. Now, to accomplish this, we have set up a number of different working groups, which maybe I should talk about those a little bit to help maybe folks understand how we're trying to tackle this issue. So the first one is a data and research working group. So one of the things about climate is you soon get to understand how much data you need and how little data there are, right, in some cases. So we've got a team that are working on bridging our data gaps, understanding our data gaps, and then looking at outside stakeholders and counterparties. Where can we get the information that we need? That group is also doing some research on the potential effects of natural disasters and what does that do for borrower behavior, et cetera. That's too early to talk about now. They're still working on it, but we are coordinating with what researchers at Fannie and Freddie are doing as well, so we're not duplicating there. The second working group we have is one on corporate governance. So corporate governance, is really critically important in our view to ensuring that climate change and its consequences get the prioritization at each of our regulated entities that it deserves. So we've been working very, very closely with our regulated entities to shore up their corporate governance around areas related to climate. And you'll see those not necessarily from an announcement from FHFA, but you'll see it in the disclosures of our regulated entities. You'll see them in how they talk about their board committees and things of that nature, their senior management committees. So we're feeling pretty confident that they all have now a much more focused look at climate change and its consequences than maybe they did a while back. Another group we have set up, another working group we have is on reporting and disclosures. We know that there's a proposed rule from the SEC, and that's a huge hurdle to meet to be able to meet the requirements of that proposed rule. We don't know what the final rule will look like, but we are working with our regulated entities to make sure they're trying to get ready for whatever rule becomes final. So that brings up, if we have to measure emissions, then how do you do that, right? So there's a lot of work to be done there. But in the meanwhile, Fannie and Freddie have each issued voluntary reports. They're called SASB reports, and the Sustainable Accounting Standards Board, which has now been subsumed by a larger group. But the point is they're voluntary reports to talk about what each entity is doing in climate, in social, and in governance, in ESG more generally. So we've been working very closely with them. So that's our reporting and disclosure and governance. We also have a group that is looking at assessing exposure. We call it assessing exposure. But what that means in my mind anyway, I think everyone else's, is assessing exposure now and over time.
Right.
And so think scenario analyses, think stress tests. How do our regulated entities ensure that they're ready for whatever could happen? We had the home loan banks actually had a conference a number of weeks ago to bring a bunch of vendors in to talk to them about how they might do scenario analysis. And they were kind enough to invite me and a couple of my colleagues down to that conference. So I think all of our regulated entities are taking this very, very seriously. But it's a heavy lift, and we want to make sure that we do scenario analyses that make sense, and also some form of stress tests. Maybe not your typical Dodd-Frank stress test, maybe something more specific to climate.
Sure.
But basically, we want to make sure that we're not caught unawares of what could happen. So there's a lot of work that has to be done there. We've got to find out, do we have enough data to do that work? Do we have the modeling technology to do that work? Do our regulated entities have the data and modeling technology? What assumptions have to be made? So, sorry, getting in the weeds here, a little boring.
It's all so interesting.
That's the kind of stuff we're doing there. We also have a working group looking at green bonds. So Fannie Mae is a big issuer of green bonds. These are a function. They're targeted at mostly lower income Americans. So think apartment buildings with efficiency enhancements, low flow showers, and things of that nature. But also in the single family space, these are incentives to make your home more efficient. That when you are borrowing from your lender, the lender will know of these programs, and you can get ultimately a lower rate on your mortgage because Fannie and Freddie are providing incentives to enhance efficiencies. And as I said, they're targeted at those most in need. One of the things that came very clearly through in the comment letters that you all sent and the NCUA sent was this recognition of the potential disparate impacts on lower income Americans. We get that, and we are that is big. That's something we've been talking about since we started this work.
Right.
So it wasn't new to us, and I think the fact that those programs, the green bond programs, are targeted at lower income homeowners and renters is evidence of our prioritization to help people that are disadvantaged. So that's the Green Bond Working Group. We also have a Consumer Protection Working Group, right? Again, trying to put our actions where our words are. What are they trying to do? Well, we're trying to figure out ways for our regulated entities, and indeed us, to evaluate decisions that the firm or we might make in the context of what will this do to disadvantaged and vulnerable communities.
Okay.
So, we're still working on this. We don't have it all finalized yet. Far from it. But that's kind of what we're doing in the Consumer Protection Working Group. We also have a working group devoted to the agency's carbon footprint. So this is one that Director Sandra Thompson was insistent that we have. She wants to make sure that we're living by what we're preaching,
right?
And that we're trying to look for ways to lower our carbon footprint. So again, we're working with other parts of the government to see what they're doing and see what we can do. And we have a legal group that kind of helps us understand, what are any statutory guardrails or whatever that we have to understand. So that's the kind of general nature of the working group. I think I ticked off all 8. But that's so you asked, I'm sorry for the long answer, but this is in response to how do we think about climate change. This, I thought, was a good way to explain to your viewers how we're thinking about things. These are the areas we are focusing on. And along the way, I would just say, if you or anyone else has ideas for things that we're not thinking about that maybe we should be, we have a kind of a ongoing outreach to stakeholders, and we'd love to hear people's views.
Great. Yeah, absolutely. We'd love to participate and continue the conversation on this issue, because it is a really important issue. Not, it's one that's not going away. And you described this multifaceted approach, which seems to be appropriate for an issue that is so difficult to measure and to nail down, the long-term, even short-term impacts, because it's so unpredictable in a lot of ways. This, SEC rule that you mentioned, I know, is obviously a big topic of discussion and focus for SEC filers, but credit unions are not in that bucket. Of course, they're not publicly traded institutions, and so, but there's still this thought that, what is the credit union regulatory framework going to look like down the line? Will there be some sort of equivalent, disclosure requirements or, evaluation from the regulator? So there's a lot to figure out, the scenario analysis, stress testing, all of that stuff, are, questions that we're asking and mulling over, and our members are thinking about and trying to get an understanding of, where the regulators fall on these issues. And I mean, housing is one of those areas in industries where the risk may be the greatest for borrowers. So certainly something that our credit union members want to learn more about and understand. And so that kind of tees up my next question, and that's, how will climate change impact the housing supply and the housing finance market overall in the next 5 to 10 years? If you had a crystal ball and could just tell me the future, what do you think those impacts might be, and what are we seeing today?
Now's probably the time when I should kind of issue my standard disclaimer that I don't speak for the agency. I'm here speaking for myself, and the way we make policy decisions at the FHFA is that we bring recommendations to the director, or she has suggestions. We go through a very, very deliberate process. So
Sure.
I'm just speaking for Dan
This
here
is
today.
this is you, Dan Coates, yes.
But in terms of housing supply, the short answer is I don't know how it's going to affect housing supply. In some cases, you see folks responding to natural disasters by leaving the area. In other cases, you actually see the opposite. You see people moving into climate-prone areas. So I think there's a lot of research being done in that space.
And I know there's some effort to like retrofit homes and things like that and make them, more sustainable.
Yeah. I mean, that's, Fannie Mae and Freddie Mac have a charter that requires them to purchase mortgages throughout the country. We don't discriminate. They don't discriminate based on geographic.
Yes.
The home loan banks accept collateral on a wide range of differing types of collateral that are defined in the Home Loan Bank Act. So I appreciated the comments that you all raised, and that the Credit Union National Administration raised about the potential deleterious effects on credit unions. And so I would just say that we do have this national mandate. In terms of what's going to affect, so what do I think will happen in housing? Gosh, if I knew that, I'd be a very wealthy person. I suspect that there will be regional effects. Sure. I suspect that insurance rates will, as we're seeing, will rise in certain areas. I suspect that housing will therefore be affected in some way or another. I mean, the part I talked about earlier where people are moving into climate vulnerable areas and moving out at the same time, all that has to sort through. But I think at the end of the day, there probably will be regional effects. I'm not so sure about national effects.
Right.
We all have to live somewhere. But what we are committed to doing is making sure that our regulated entities not only remain safe and sound, but continue to achieve their housing finance mission. And that is making available, sustainable housing in the manner I talked about earlier, which is why I made that comment just a few minutes ago about the national nature of the business they do.
Right.
So it's just something we all have to deal with. So I hope that helps.
Yeah, that is helpful. And I mentioned earlier, something credit unions are spending a good bit of time thinking about. And, my question is how lenders like credit unions should be assessing, the risks, both in the respective, immediacy and also the magnitude of these risks, and how, if at all, this may be factored into pricing on loans that are then sold to the GSEs, or is that not something that is being considered or evaluated?
So what I can say is that we do have pricing advantages for homes that are having efficiency improvements added. But in terms of a general discussion of pricing, that's really that's a question for our director, and I think that's all I want to say about that. That's her purview, not mine.
Sure.
I'm here to provide as much information and analysis about the environment we're seeing with respect to climate and ESG matters, and ultimately that's her call.
What have you seen from lenders, though, about how they're evaluating these risks?
Well, I think that everyone is becoming more aware of the risks of various properties. you can go to various real estate websites and dial up a property, and you can see what either has been said by various parties about the risks of that property. So I think I don't have a regular discussion with lenders, so I can't really answer that question.
Sure.
But I think it's a fair statement that everyone is becoming more and more aware of the risks that these properties have.
Yeah, and as more data are collected, I'm sure that risk analysis and assessment will become a little easier to conduct.
Yeah, I think so. We actually recently hired a geographer to
Oh.
help us kind of dial into the actual property level to understand the risks and understand the data that we're getting.
Right.
Yeah, I think it's, but there's I will tell you one of the dominant things that I've heard at the FSOC. You asked about FSOC earlier. They have a climate-related financial risk committee. They put out a report in last October. We actually helped to contribute to that report. And what I hear from them, and by the way, we meet bilaterally with NCUA and every other federal financial regulator out there that we can find, and we meet with them basically quarterly.
That's great.
And in every single instance, this recognition of how we're going to deal with this climate crisis and try to help the disadvantaged is paramount. It is something that we all are thinking about.
Right.
It's really at the forefront of how we're thinking about these things, and it will prevent. I mean, I the sense I got from y'all's comments and others was, for lack of a better phrase, no sudden movements, please. And I would offer you assurance that we are moving slowly and steadily, acquiring information, talking to stakeholders, trying to educate ourselves, working with our other federal regulatory colleagues and even one state financial regulator, so that we can understand the consequences of anything we would do, which is
Exactly.
That's the whole point here, is be slow and deliberate. And I will tell you, there are a lot of folks that wish we would move right now, but we're going to be we're going to be slow and deliberate and do it right, so that we can try to make sure that that everybody can adapt to the increasing frequency of natural disasters, and that no one gets left behind.
Right. That's good to hear. And I think the main concern from our members and the feedback that we were, getting, which prompted us to then submit those comments, was, we don't know what we don't know.
Yeah.
And there's so much, more data, more information to gather before, any prescriptive policy, positions and requirements and rules can be put in place. So that's where the industry stands at this point.
Yeah, I mean, I think there's a fair amount of humility in this space. I think we're all kind of painfully aware of how little we know in this space, but we're all working as hard as we can, gaining knowledge, gathering, hiring folks that work in this area. We hired some economists specifically to work in climate. So we're really serious about this, but we're going to do it, slowly and deliberately, and hopefully the right way.
And the geographer that you mentioned, right? So, credit unions are sometimes, very geographically concentrated and, have business lending restrictions that, limit some of their potential climate risk, like exposure to the fossil fuels industry, but field of membership limitations and standards can lead to a geographic concentration in some instances. So, how does that sort of concentration, you touched a little bit on it earlier, that it's not going to be national. It's going to be a little more, focused and segmented, by geography. How does that play into the climate risk and the analysis and evaluation that lenders should be doing if they're not, working with this national footprint, but are in specific, limited geographic areas?
So I mean, as I mentioned earlier, our entities have a national footprint, and they treat that responsibility seriously. So we're going to provide the same opportunities for people seeking mortgages, regardless of where they are. But if I try to put myself in the shoes of someone at a credit union, I guess what I would think of is try to get as much information as you can about the risks to that property. And there could be good information there too. It's not always just looking for downsides, right? If you find that the property has had resiliency improvements, a lot of work has been done in New Orleans to make those properties more resilient, then maybe that's something that you can give some benefit to the borrower for. Similarly, for efficiency enhancements, if the property has had some enhancements to shift over to electric heating and air conditioning, for example, that may be a lower carrying cost for the borrower over time. Right? Because if the costs of fossil fuels were to rise suddenly and in a sustained way, not just like a blip, but in a sustained way, that's one of the things we worry about is homeowners being essentially unable to continue to carry their mortgage because of this transition policy risk. So if I was at a credit union, I might be looking at what are some of those things that maybe can give me some comfort to lending to a household in a vulnerable, climate vulnerable area. But I would also, have eyes wide open and try to think about what I have been reading about in terms of insurance behavior, if you will. So in some cases in California, a lot of insurers just refuse to participate in fire insurance. So the state came in with a kind of a backstop program. So I think there are things to be aware of there. And I think of this all as basic risk management, right? This is just gathering information so you can make an informed decision. And that from a lifelong government employee. So you take that for what it's worth. But that's the way, I have been involved in helping to supervise and regulate financial institutions for the majority of my career. And those are the kinds of things that we always talk about is risk management. How do you identify, measure, and manage those risks? And I think climate is yet another of those risks. It's kind of a cross-cutting risk, so it's not easily siloed into operational risk or credit risk. It's a whole bunch of different risks.
Right.
But that's my thought about that.
Yeah, but it does, squarely fall within the realm of risk management. And, you talked about transition risk, but there's also, the regulatory risk. We talked a little bit about that, and physical risk. I mean, obviously not just to the collateral, maybe, the homes that your borrowers are in, but also the branches that you may have as an institution. So there's a lot to think about and evaluate there. But you also mentioned, insurance programs and, what may or may not, change in that space. And of course, we've got the National Flood Insurance Program, but there's also private flood insurance. And, could you describe what, if any, challenges you may see, with that program and how private flood insurance compares, and, whether there may be some potential reform opportunities to provide a little more security and stability for borrowers and lenders?
Sure. So one thing you should know is that Fannie and Freddie require that any loan that is in what FEMA calls a special flood hazard area, so that's 1 in 100 year likelihood or more of flooding, that loan carry flood insurance for the life of the loan. And we've actually looked into that. We've looked at the servicers and whether they're checking that, and they are. So that's a little bit about just some comfort, I think, that we can draw from the fact that the most vulnerable homes in these special flood hazard areas, if their mortgages are sold to Fannie and Freddie, they are required to have flood insurance. So that's a good thing. The number of homes, there are a number of homes outside of the special flood hazard area that have been affected by flooding. And of course, that's what we're all trying to figure out, is how can we make sure that those homes are adequately insured.
Yeah, you read my mind. What about those homes that aren't, within or designated as special flood hazard areas, or, the flood maps maybe haven't been updated and aren't accounting for, changes in weather patterns and increased risk of flood.
Right. So that may be one of these whole of government approaches that we need to think about in terms of ensuring, try to incentivize those homeowners outside of special flood hazard areas to acquire and retain the insurance they need over the life of the loan to protect themselves. But again, that's
not so simple.
Yeah, it's not so simple, and it's not my ability to affect. Right, that's a bigger policy issue. In terms of the National Flood Insurance Program itself, I would just note that they have rolled out their risk rating 2.0, but really the questions about that program are probably best directed to folks at FEMA. We have been working with them quite a bit, but they're the ones that should talk to you about that.
Right. Yeah, well, I may have to invite someone from FEMA as my next guest then. Sure. Long term, 20, 30, 50 years into the future, what do you think may be the best solutions for ensuring that, the housing sector is equipped to handle whatever may come its way with respect to climate change?
I think information, so there's really, I don't think there's a single solution. I think there's going to be a number of ways we try to tackle this problem, and hopefully we'll be successful. But I think of it a little bit like food labeling. So when food labels first came out, you'd see it in the supermarket. Okay, there's a label. Maybe you paid attention, maybe you didn't. But as time goes by, you start to read that label and you realize, oh my goodness, I can't eat
I can't pronounce half of the stuff on here. I don't know what it is.
What's in there.
Maybe I shouldn't be consuming it.
And over time, it tends to affect our behavior, right? I feel the same way about climate, that the one core element that I think will help us as we move forward on this is information. And I worry about too much information coming out too quickly, because I am specifically worried about those vulnerable communities, and I don't want the value of their homes to drop precipitously. But as we continue to worry about that and think about what we do, information's coming out anyway, right? So you as I mentioned, these websites, you get on these websites and you find out what the risks of a given property are. So I think in general, as all of us as Americans learn more about climate risk, we see it on the news every single night, it seems. I think we're going to start demanding more information. Is this home or apartment building up to the latest building codes? Is it? If not, why not? I think people will start asking those questions.
Sure.
If I was renting an apartment, I might be asking that question. I was thinking about buying a home. What are the codes? I think it will come kind of organically throughout the chain of homeowners, renters, lenders, servicers, and yes, even Fannie and Freddie and the home loan banks. But those entities at least are committed to this space, and they're going to be there, and they're going to continue to try to achieve their housing finance mission. So I think there's some comfort in that. But I do think that over the long term, increased information, increased awareness, well, it always helps us, right? It always helps us make better decisions.
Right.
So that's my hope for climate.
Yeah, well, I hope you're right as well. And, you mentioned a number of times the focus on vulnerable communities and populations, and the green bonds and the consumer protection working group, or team that's working to ensure the entities have programs in place that can help these communities. Is there anything else that you'd want to highlight there? Any other initiatives? I mean, NAFCU has been supportive of specific types of lending programs, wealth building home loans, programs that are targeted towards buying more mortgages from community development financial institutions, MDIs, things like that. So, what else is the agency evaluating in this area to help those underserved and vulnerable communities? And I know maybe that's not something you want to.
Well, we're doing a lot, but I'm probably not the right person to talk to you about that. There are a lot of things that we're doing, as I mentioned, even in the green bond space. We're targeting low-income communities so we can make sure that those communities benefit. But it's I'm sorry, I'm here to talk about climate today, so I probably would.
But nothing else specifically related to climate.
Gosh, I'm going to kick myself later if I think of something after we leave here. But those are the big things.
Right.
And as I mentioned, we're still engaging with stakeholders. We're still talking to folks.
Right.
We're thinking about what the enterprises and the home loan banks should be doing next year. Right. And this continual dialogue with folks will continue. So that way we can, we're not only working with FEMA, we've been in discussions with DOE in terms of efficiency improvements and how we could incentivize those. Again, this is all very, very staff level, and nothing's anywhere close to being even in the proposal stage. We're just kicking around ideas and trying to learn from each other.
No big decisions have been made, but
really trying to learn from each other. But that is, it should signal to you all that we are really trying to put our heads together and think of how we can be a force for good here in this space and help the housing finance sector adapt, because I think it's the right thing to do for renters, for home borrowers, homeowners, right. and for the GSEs ultimately.
Yeah, well, that sounds great. The more information, the better. And, like you were saying, the more likely that you'll, reach a better solution or, policy proposal, with the more information and data that you gather. So fantastic. Any final thoughts, parting words for our viewers and listeners?
No, I hope you found it of value. I hope what we're doing makes some sense. And I really appreciate the opportunity to speak with you and your audience, and really just it's a great opportunity, and we're very, very serious about trying to make as much progress in this space as we can. So really appreciate the opportunity to tell folks what we're doing. There's a lot of it seems like there's not a week that goes by that I don't get a request, or Director Thompson doesn't get a request to talk about what we're doing in climate. And so it's a busy time for us. But as I tell the director frequently, I just love this job. I just love what we're doing, and I think we're all learning. And I think when we're learning and trying to come up with new ideas and make some change for the better, it's very exciting. The team that I work with in climate is spread all across the agency, and they're all bought into it, and they all love it, and they're all excited about the work. The senior leadership of the agency is committed to this. Our director is committed to this. So we're all in. We're enjoying the heck out of it. And it's a lot easier to talk to my kids now because I can talk to them about climate, and Okay, good, Dad. You're doing something good.
Aw. Yeah, well, Mother Nature in a lot of ways is, the great equalizer, right?
Yeah,
So
yeah.
we really don't have much of an option but to think about all these things. But it does sound from what you've described that, the FHFA is really taking this very seriously, as are other agencies. And, you're all trying to work together to find
Yes.
solutions and, ways to tackle this.
Yeah, I forgot to mention we're also a member of the network of central banks and supervisors for
Mm-hmm.
greening the financial system. So that's this international group. So we're really trying to work with these other bodies so that we can learn as much as we can and contribute to some solutions here.
Yeah.
But I really appreciate the views of your members as you penned in your note. And similarly from NCUA, you raised good points, and we take your points seriously. So thanks for taking the time to comment to us. I appreciate that.
Absolutely. And we'll continue to share the perspectives of our members in the industry. And thank you again. And that does it for this episode of The CUPP. Stay tuned for more interesting discussions. Until next time.